Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Applovin Corporation annual report. Applovin Corporation offers a diverse range of services to various clients across the globe. The company's primary focus lies in providing software-based solutions for advertisers to enhance their marketing and monetization efforts. Its advertising segment includes App Discovery, an advertising solution that matches advertiser demand with publisher supply through auctions, and Max, an in-app bidding technology that optimizes the value of a publisher's advertising inventory. The company also offers various products under its app segment, including Adjust, a measurement and analytics marketing platform, and Whirl, a connected TV platform that distributes streaming video for content companies. Additionally, Applovin provides Spark Labs, which uses App Store optimization to enhance ad visibility, and Applovin Exchange, which connects buyers to mobile and CTV devices through a single RTB exchange. Furthermore, the company operates an end-to-end app management suite called Array, designed for mobile operators and end users. Moreover, Applovin Corporation operates various free-to-play mobile games through its own or partner studios. Its services cater to individuals, small businesses, enterprises, advertisers, advertising networks, mobile app publishers, and indie studio developers. Applovin Corp's stock price drop. A year of turbulence in the past year, Applovin Corp. App has faced significant challenges that have led to its stock price dropping by over 8.45%. The company's struggles began in late 2025 and early 2026, driven by competitive concerns, regulatory investigations, and market reactions to earnings reports. One of the primary causes of Applovin's stock price decline was increased competition from Meta platforms and other companies. In February 2026, the company's Q4 2025 earnings report sparked investor concerns about its high valuation and future growth prospects. The stock dropped nearly 20% on February 12, 2026, following a 16% fall on February 4 due to the announcement of a new competitive threat from CloudX. Regulatory investigations also played a significant role in Applovin's stock price decline. In October 2025, reports emerged that the U.S. Securities and Exchange Commission, SEC, was investigating the company's data collection practices, causing its stock price to drop by about 14% on October 6, 2025. Market sentiment also contributed to Applovin's struggles. Broader market concerns about software companies and fears of disruption in the advertising technology sector due to advancements in artificial intelligence, AI, weighed heavily on the company's stock. The combination of these factors led to a significant decline in Applovin's market capitalization, falling by approximately 40% since the start of 2026. Overall, Applovin Corp's stock price drop can be attributed to a combination of competitive concerns, regulatory investigations, and market sentiment. These challenges have had a lasting impact on the company's valuation and growth prospects. Applovin Corporation market capitalization of $139 billion is significantly larger than the average industry peer of roughly $0 billion. This shows that Applovin Corporation holds a significant advantage in their industry. Applovin Corporation trades at a higher price-to-earnings ratio of 41 times and a higher price-to-book ratio of 65.29 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The company exhibits a very high leverage profile, with liabilities accounting for 81% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The company has consistently reduced its share count while revenue has grown, but declining assets and equity suggest buybacks may be taking precedence over reinvestment. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline for a company can be complex and multifaceted. However, based on the provided summaries, it is clear that several key factors contributed to the significant revenue growth experienced by the company in 2025 compared to 2024. One major driver of revenue growth was the improved performance of Axon Ads Manager, which saw revenue growth of 70% and 75% in 2025 and 2024, respectively. Additionally, increased volume of installations and higher net revenue per installation also contributed to the company's revenue growth. Furthermore, a decrease in sales and marketing expenses due to reduced stock-based compensation, related payroll costs, and headcount reduction helped boost profitability. On the other hand, some factors may have hindered revenue growth or led to decline. For instance, an increase in general and administrative expenses due to higher professional services costs and bad debt expense could have offset some of the gains from improved Axon Ads Manager performance. Moreover, a goodwill impairment of $188,943 in 2025 may also indicate potential issues with the company's assets or financial health. Overall, while the exact drivers of revenue growth or decline are not explicitly stated, it is clear that a combination of factors contributed to the company's significant revenue growth in 2025. The net income of the company has experienced significant growth over the past 2 years. In 2024, it increased by a substantial 353% compared to 2023, reaching $1,579,776. This upward trend continued in 2025, with a notable 105.7% increase from 2024, resulting in a net income of $3,333,751. The profit margins have also shown improvement over the same period. The net margin rose from 19.4% in 2023 to 49% in 2024, and further increased to 60.8% in 2025. Similarly, the adjusted EBITDA margin improved from 67.1% in 2023 to 74.8% in 2024, and then to 82.3% in 2025. The revenue growth has been substantial as well, with a 75% increase from 2023 to 2024, and a further 70% rise from 2024 to 2025. This significant expansion in revenue is likely a key factor contributing to the improved net income and profit margins. The company's financial performance has shown significant improvement over the past 3 years. In 2025, revenue reached a high of $5,480,717, with an impressive adjusted EBITDA margin of 82.3%. This indicates that the company is efficiently managing its costs and generating substantial profits from its operations. A closer look at the financial data reveals that the company has been consistently generating positive operating cash flow since 2023. The net cash provided by operating activities for each year is as follows: $1,061,510 in 2023, $2,099,011 in 2024, and a substantial $3,971,094 in 2025. This trend suggests that the company's financial health is improving, with increasing amounts of cash being generated from its core operations. The positive operating cash flow status is confirmed across multiple pages, including page 41, page 42, and page 48. This consistency reinforces the notion that the company is on a solid financial footing, capable of generating sufficient cash to support its growth and expansion plans. The company's debt level has remained relatively stable over the past few years, with only minor fluctuations in total debt and long-term debt. According to the financial reports, the total debt was $3.6 billion as of December 31, 2025, which is a slight decrease from the previous year when it was $4.2 billion. Additionally, the long-term debt increased by just $4 million from 2024 to 2025. In contrast, the company's interest expenses have seen a significant decline. The interest expense and loss on settlement of debt decreased by 35% from 2024 to 2025, with a notable drop in interest expenses from $307.98 million in 2024 to $200.6 million in 2025. This reduction in interest expenses is a positive trend for the company, indicating that it has managed its debt effectively and reduced its financial burden. The performance of various segments and regions in the e-commerce industry has been mixed. On a positive note, web-based e-commerce advertisers have performed well, indicating a strong demand for online advertising services. However, other areas have struggled. International markets have faced significant challenges due to increased risks under anti-corruption laws and uncertainty surrounding export control and sanctions regulations. This has resulted in poor performance from these regions. China is another area that has been impacted by recent changes in U.S. tariffs and export controls. The country may continue to retaliate against the company's business, further exacerbating the situation. These challenges have contributed to a decline in performance from this region as well. Management's outlook for the company is one of growth and expansion. They expect to increase revenue by improving technologies such as Axon AI recommendation engine, which will enable them to expand into new verticals outside of gaming. The company plans to focus on attracting and retaining clients through improved advertising solutions and sales efforts. In terms of strategy, management is prioritizing innovation, particularly in advertising solutions and technology. They have divested the apps business to focus on their core advertising business, which generates revenue from AI-powered advertising solution Axon Ads Manager. This shift in strategy will enable the company to maintain a strong financial position and effectively manage debt. Overall, management's vision for the company is one of continued growth and innovation, driven by investments in technology and a focus on its core strengths. The company has made several significant acquisitions and divestitures over the past few years. Acquisitions have been a key part of the company's growth strategy, with notable purchases including Adjust in April 2021, Twitter's MoPub business in January 2022, Whirl in April 2022, and investments in Humans, Inc. The company has also acquired Class A common stock from KKR Denali, purchasing 15 million shares in August 2023 for $552.8 million, and 16 million shares in May 2023 for $335 million. In terms of divestitures, the company sold its apps business to Tripledot in June 2025 for $400 million in cash. This sale generated significant proceeds, with the company reporting $407.3 million in net proceeds from the transaction. Additionally, the company has reported discontinued operations, although specific details on what was divested are not provided. The company has a history of buying back shares as part of its capital management strategy. In recent years, the company has made significant investments in share repurchases, with specific amounts mentioned in the financial reports. For 2025, the company repurchased $2.2 billion worth of shares, including 5.5 million shares at an average price of $400 per share. Similarly, for 2024, the company spent $981.3 million on stock repurchases. The company has also utilized debt to fund its share buyback activities. In March 2025, it borrowed $200 million from a revolving credit facility to finance share purchases. Additionally, in March 2024, the company drew $418.7 million from the same facility to fund certain share repurchases. These transactions demonstrate the company's commitment to returning value to its shareholders through strategic capital management decisions. While the company has not paid dividends in recent years, it has instead focused on buying back shares to enhance shareholder value. This approach reflects the company's priorities and financial goals, which may be influenced by various market and economic factors. That concludes the financial summary for Applovin Corporation. Feel free to comment below, and I will be happy to answer them when possible.